So let us understand first what is a capital structure. Before understanding the different theories of capital structure, let us understand first the meaning of the capital structure. What is a capital structure? So capital structure is nothing but capital structure is the combination of capitals from different sources of finance. So structure means what? Combination. So capital structure will be combination of capitals from different sources. So you know that there are various sources of finance, long-term finance, like through which the company can raise the funds for running their business. First is the equity, then preference share, okay, long-term external debt, that is borrowings from banks, financial institutions, etc. So these are the sources of finance through which the business can raise funds. So what is the combination of these capitals, long-term capitals? It is known as capital structure. So equity will be there, preference share will be there. If we are talking from a point of view of company, okay, then long-term borrowings will be there from banks, financial institutions, etc. So these, how they are in proportion, how, in which combination they are, it is called as capital structure. So if you're talking about an sole trading business or a partnership business, it will have its own capital structure. Like initial investment will be there, which will be the capital. Then loans will be there. So it will be the capital structure for a non-company form of organization. But for a company form of organization, capital structure will be mainly consisting of equity shares, preference shares, and long-term borrowings, external debts. So write and keep, note it down. Capital structure is the nothing but combination of capitals from different sources. Now, before deciding the capital structure, you should take into consideration some important points, that how you have to structure your capital, whether you should be more equity oriented company or a debt oriented company. So before taking that decision, you should keep into consideration some factors. What are that factors which you should keep in your mind before deciding the source and quantum of capital? Okay, from which source you have to raise finance and how much you have to raise. So what are the factors which has to be considered before deciding the source and quantum of capital, that is amount of capital, how much you have to raise from these different sources, equity, preference, long-term borrowing. First is the control factor you should keep in mind before deciding the source and amount of capital. So capital structure should be decided in such a manner that the existing shareholders continue to hold majority stake. So we know that equity will give the controlling interest. Other type of investments will not give you the controlling interest. Preference shares, debentures. Okay, there can be debentures also, debentures and deposits. So all these forms of capital investment will not give you the controlling interest in the company. Only equity, if you invest in equity, you will get the controlling interest. That is, you become the ownership interest of the company. You will get if you invest in the equity shares of the company. So before raising the further capital, company should keep in mind that existing shareholders will continue to hold the majority stake. There is no dilution of control. Okay. Suppose if equity shares is there, further new equity shares are issued, then it will dilute the control. No? Okay. So if company wants that control remains with the existing shareholder, then it will not go for further equity issue. Then it will check the other alternatives. Okay, it may go for borrowings or debentures. Okay, so that control is not diluted. In other case, if control is not that much important for a company, it can go for an equity. So it depends upon the preference of company to company. Okay. Then another thing which company has to consider is the risk. That capital structure should be designed in such a manner that financial risk of a company does not increase beyond tolerable limit. If debt to capital is more, then a risk will be there because a repayment should be done regularly. If equity is more, we know that equity shareholders are residuary interest, have residuary interest in the company. Only if there is left out profit, then company can declare the dividends, etc. Or in case of winding up, if there is a profit after paying all the other persons, after that only equity shareholders will be given preference. So a risk factor company can consider before taking a decision on the capital structure. Okay, because debt capital will increase the risk, obviously, because there should be regular service of interest and payments, etc. Okay, and repayment should also be done at the maturity period. This can be another factor which company can consider before deciding its capital structure. Okay, these are all individual preference of the company and policies of the company. But these are the overall things which a company should keep in mind, firm should keep in mind before deciding on the capital structure. Another important thing is the cost. Overall cost of capital remains minimum. Okay, now can anybody tell which will be the most costly source of finance out of these equity, preference, debentures, long-term borrowings? Which will be the most costly source of finance for a firm? Yes, very correct. Equity is the costly source of finance because equity shareholders are having residuary interest. So their cost will also be high. Other types of investment, there is a regular payment of interest, etc. in case of debts, etc. So equity shareholder, equity is the costly source of finance. So if company wants to reduce the cost of capital, then it will go for other type of finance, preference, debentures, borrowings, etc. Then it will try to reduce its equity in the capital structure because equity is the costly source of finance. Note and keep, very important point it is. So these are all the some factors which company should keep in mind before deciding on its source of capital and how much it has to raise from different sources. That is control, risk, and cost. Now, practically, if you will see, all these three are conflicting with each other. If you want to reduce the cost, okay, then it will be difficult for you to achieve the risk principle. Because if you want to reduce the cost, you will have to increase the debt capital. So risk will be there. Okay. At the same time, if you want to maintain controllability feature, then also you will reduce the equity. If you want to reduce risk, then you will have to go for equity. then your control and cost factor will be affected. So practically, if you will see, these three goals are conflicting. So it is not practically possible to achieve three goals together because it cannot work together, three goals together. Hence, finance manager has to make a balance among these three objectives. So you should take an optimum decision regarding these three goals, that is control factor, risk factor, and cost factor. So practically, now you have understood that all the goals are conflicting each other. So how these goals can be reconciled? So it is the duty of the finance manager to take a balanced decision. What is the objective of every company? Every company is to maximize the value of the company, and it is the prime objective while deciding the optimum capital structure. So objective of every company is to maximize the value of the company for the shareholders. Okay, capital structure decision refers to deciding the form of financing, that is from which source you have to raise the funds and what is the amount needed from each source, actual requirement. Okay, and their relative proportion in capitalization. So normally we say no, equity is 40%, debt is 60%. Means equity is 40% in the company's capital structure, debt is 60%. Like this, different companies will have different combination. That is the meaning of capital structure. Now, how value of the firm is calculated? See, value of the firm, note down this formula. Value of the firm is earnings before interest and taxation divided by overall cost of capital. Or you can call it as weighted average cost of capital also. So EBIT divided by weighted average cost of capital or overall cost of capital. Weighted average cost of capital, how to calculate that we will understand. You have already done it in your F5 BAF. How to calculate the weighted average cost of capital. So value of the firm will be EBIT divided by weighted average cost of capital, which is also, you can call it as overall cost of capital. Okay, so weighted average cost of capital also you can call it as KO. Overall cost of capital is KO, weighted average cost of capital. So right, and KO means overall cost of capital, that is WACC. KD means cost of debt. KE means cost of equity. So if you will understand this formula technically, it is capitalizing the earnings before interest and tax. You will get the value of the firm. If you have studied valuation in accounting, there is a one method of calculating the value of the firm, no? Earnings based approach. There you used to calculate the future maintainable profit, EBIT. Then you capitalize it using your normal rate of return. You will get the value of the firm. So it is similar to like that, EBIT divided by weighted average cost. So it is capitalizing the EBIT, you will get the value of the firm. Understood? So it is capitalization of EBIT. this sum is relatable to this formula which we have done. First, we will discuss this formula sum. Rupa Limited CBAT is 5 lakh. Company has 10%, 20 lakh debentures. Equity capitalization rate is 16%. You are required to calculate the market value of equity and value of the firm, overall cost of capital. So two things are required in this question. EBAT is given and company has a debt capital of 10%, 20 lakh debentures. Equity capitalization rate is given 16%. We have to calculate two things. Market value of the equity. What is the value of equity? Okay, and after that we have to calculate the value of the firm. And we have to calculate the overall cost of capital also. So how we will calculate? Before calculating the value of equity, it is not possible to calculate the value of the firm and also cost of capital, overall cost of capital. So first we will have to calculate the equity. See, debenture is given 20 lakhs. So we know equity plus debenture, this will give us the total value of the firm. Correct. Market value of equity and market value of debt is equal to total value of the firm. What is the value of the firm? So debt to capital value, it is already given in the question, 20 lakhs. Now first we will have to calculate the value of the equity. If we get the value of equity, we will get the value of the firm and also we will get the overall cost of capital also. So how we can calculate the value of the equity? Yes. Any? Okay. So let us calculate how to find out the value of equity. Simple it is. See what data is given. Say, let us calculate that. EBAT is given. EBAT is 5 lakh rupees, 5 lakh. Value of debt is given. That is debentures. Debenture is a debt only. Value of debenture is rupees 20 lakhs. Clear? 20 lakh debentures. Then KD is given. Cost of debt is 10%. KE is given 16%. So these are the basic details. So first we will find out the calculation of value of equity. So how we can find out the value of equity? Simple. Particulars amount rupees. So EBAT is given. EBAT is how much? 5 lakhs. From this we will reduce first the interest on debentures. What is the interest on debentures? Anybody can tell? What will be the interest on debentures? Interest on debentures is 10%. So what will be the interest on debentures? See, debenture is 20 lakh. So 20 lakh into 10% will be 20 lakhs into 10%. So 2 lakh is the debenture. So if from EBIT, if you will reduce the interest on debenture, we will get the earnings available to equity shareholders. Clear? So this is the earnings available to equity shareholders. This much understood. This part is very important. EBIT minus interest will become earnings available to equity shareholder. If preference share capital is given, then we will have to reduce the dividend on preference share also. Then we will get the earnings available to equity shareholders. This much understood, everybody? Earnings available to equity shareholder, KE is there. If we will capitalize KE, we will get the amount of equity shareholder. So value of equity shareholder will be, value of equity will be, write this formula, earnings available to equity shareholder divided by KE. So 3 lakh divided by 0.1. So value of equity will be, value of equity is 30 lakhs. Understood? So you write full year earnings available to equity shareholder. So value of equity will be earnings available to equity shareholder capitalized at KE value, KE percentage. So we'll get the value of equity 30 lakhs. Now we have got the capital structure. Equity is 30 lakhs, debt is 20 lakhs. Okay. Now value of the firm will be, value of the firm will be, value of the firm is simple. Value of the firm is value of equity, value of equity plus value of debt. Understood? Both values we are having, both values we are having, no? Value of equity and value of debt. What is value of equity? Just now we have calculated 30 lakhs and value of debt is given 20 lakhs. So total of this will become the value of the company, which is 50 lakhs. So company's value is 50 lakhs. Okay. Understood this part? This much understood, everybody? Yes or no? Any confusion is there? Okay, yeah. It is 16%. Correct. So it should be 1/6. So here a little change will be there. Instead of 30, it will become 18,75,000. So rupee 18,75,000 plus 20 lakhs. Rupees 38,75,000. So this is the value of the firm. Here you should take 16%, not 10%, because K is 16%. So this is nothing but we are capitalizing the earnings available to equity shareholders. With the KE, we will get the value of equity. So this is the value of the firm. Now we can easily calculate the weighted average cost of capital. It is very simple. Particulars, percentage, cost, weight, or you write amount, weights, product. See, now in this company, two capital are there. One is equity, one is the debenture. Percentage of equity is 16%. Percentage of debt is 10%. Amount of equity, just now we have calculated. It is how much? 18,75,000, and debt is 20 lakhs. So total, if you will do, it is 38,75,000. So weights will be this divided by total. This divided by total. So weights total will always be 1. Now you can do the product of cost into weight. You will get the weighted average. This you have already done in your S5 map. So weighted average cost of capital will be 0.1290, means 12.9%, or you can call it as 13% also approximately. Understood this much, everybody? See, if you will capitalize the EBIT with the WACC, you will get the same amount, 38,75,000. Understood? So EBIT you will capitalize at WACC, you will get the same value, 38,75,000. See, understood? WACC, see, same amount you are getting. So two way we have proved that value of the company is 38,75,000. Product is the cost into weights, individual cost into weight. 0.16 into 0.483871, 0.1 into this one, 0.51612. Okay. So understood this much, everybody. So we can stop here today.